So now I'm a little curious as a manager of this company, where was I off? Was I off in quantity or was I off in price? What made up that $2,850 unfavorable variance? Well, my price variance is made up of my actual quantity, $10,600, times my actual price, $2.25. Okay, we've done that before. And we're going to subtract from that our actual quantity, $10,600, minus our standard price of $2.10. In other words, we're comparing here. Notice the units are the same. We're comparing the actual price to the standard price. Thus, we get $23,850 minus $22,260. Our price was off $1,590 unfavorable. In other words, we paid 15 cents more than we planned. That 15 cents times the 10,600 units we actually used gave us a price variance of $1,590 unfavorable. Well, what was our quantity variance? Our quantity variance, again, is our actual quantity, $10,600, times our standard price, $2.10. That's what we planned. From that, we subtract the standard quantity, what we thought we would use, which is 10,000, and multiply that times our standard price. Notice what we're doing here. The standard is the same price, but we're doing an analysis of the difference in what we actually used to what we planned on using. We do the arithmetic, $22,260 minus $21,000 equals, we spend again too much, $1,260 unfavorable. So by using 600 units more, we spent or had an unfavorable quantity variance of $1,260. And here's how you know you did this right. The price variance of $1,590 unfavorable plus the quantity variance of $1,260 unfavorable must equal the total variance of $2,850 unfavorable. We know we did it right. We had a total variance of $2,850, the difference between actual and standard. And then we broke it down by price. We spent 15 cents more. And by quantity, we used 600 units more. The combination of those two variances give us our total of $2,850. That's what is called a standard material variance analysis. It tells us we were off in our price and we were off in our usage. The combination of the two tells us that we were off $2,850. Again, some of you, even though I can't see you, are rolling your eyes at 10 o'clock on a Monday morning going, what the friggin' fruit do I care about this? Well, the friggin' fruit is if you're managing this cost center, the production of this product, and you're telling your bosses and supervisors, well, we plan on using 10,000 units to produce our product, and we plan on paying $2.10. But when the actual numbers came in, you were off. The next question in the analysis, which would be a scoreboard analysis, a balanced scorecard balance analysis would be why. Why did we go wrong? Where did we go wrong? Did our vendors give us the wrong information? Were we inefficient in the use of our materials? What happened? It provides efficiency analysis. There's a great quote to put in an essay question. Why do we do this, Mr. Hassey? It provides efficiency analysis. All right. 11.2a is huge. All right, that's material price variance. Now let's see what our labor variance was. Were we off in our labor numbers? All right. We were off in our material numbers all the way around. Total, price, and quantity. Now, where are we off in our labor variance? Let's see what that is. First of all, I'm going to save this. All right. Cool. And now I'm going to put this over here. And we're going to do labor over here and see what that works out to be. There's no end to the technology resources that Professor Hassey has. Unbelievable. University of Laverne gives me the state-of-the-art technology. All right, let's see what our labor variances are. How did we do in planning for our labor to produce our product? All right, first of all, our total labor variance is actual hours of labor planned times actual labor rate. From that, we're going to subtract out the standard hours that we planned on using times the standard labor rate that we planned. Again, just like materials, we're comparing actuals to the standards, to the budget, to the plan. Well, we planned on, let's say in our problem, we had actual of 14,400 labor hours. It's right in the problem there. And at a actual labor rate of $8.40. That's going to be subtracted from our standards. We planned on 15,000 labor hours at a rate of $8 per hour. Let's do the arithmetic. Our actual labor costs were $120,960. Our planned budget standard labor hours were $120,000. Uh-oh, we screwed up again. Not too bad though. We are $960 unfavorable. We are $960 over plan in our labor costs. That's compared to $2,850 in materials, but we still were unfavorable. Where were we unfavorable? Let's determine labor price variance. Where were we off on labor rate? The labor price variance. Okay, well, we planned on 14,400 labor hours at an actual rate of $8.40 a unit, an hour. Subtract that from our 14,000 planned labor hours. Excuse me, from our actual labor hours, 14,400 labor hours, times our planned labor rate of $8 an hour. Again, we're comparing the labor rates with the actual hours being the constant. Looks like we're 40 cents off. So to do the math, $120, $960 of actual labor cost minus The actual labor hours times the planned rate is $115,200. Ooh, we were really off in our labor rate. That's a $5,760 unfavorable variance in labor. We paid 40 cents more than we planned per labor hour. And we had a lot of labor hours, 14,400. That 40 cents difference called us to have an unfavorable price variance of almost $5,800. Now let's see where we're off in the labor quantity variance. We had 14,400 actual labor hours times the standard rate of $8 an hour minus the actual labor hours of 15,000. The standard labor hours we planned on 15,000 hours times the $8 per rate. And we already see now that we're going to be a little bit better off here because we planned on 15,000 labor hours to produce our product, and we only used 14,004. So do the arithmetic, 115,200 minus 120,000. We had a favorable labor quantity variance of $4,800. So we were finally some good news in our planning. We thought we'd use 15,000 hours and we only used 14,004. Thus we had a favorable quantity variance. Let's make sure we did everything right. The labor price variance was unfavorable, $5,060. We compare that, we add that to the labor quantity variance, which was a favorable 4,800, and golly, we get our total of $960 unfavorable total labor variance. Pretty good. What we did here now is we determined that we were unfavorable in both material and labor, and now, but in labor, we were incorrect in our labor rate, but we were under, or we used less labor than we planned, so thus we had a favorable variance there. The combination of the two gives us that total labor variance. So we did pretty good in the planning of how much labor we would use, but we paid our labor too much. The next part of this analysis, if I were a manager, is what happened? Why did we use less labor? Were we more efficient, or we were just incorrect in our estimates? And why did we pay our labor more? Was there overtime involved? Was there some issues with we didn't have the correct pay of some of our production people? That's the next question in the analysis. So I'm going to let you take this further and do the overhead variance and the total statement variance, income statement. The solutions are in Blackboard, but I want you, probably as practice, to complete this problem and go from there. And let me just show you something. First of all, I'm going to save this. Get out of it. Again, I'm recording this, sports fans, so I have recorded this. Let's see, where do I want to go? Here I want to go. Okay, so here's the solutions to 11.2. I give you the overhead variance analysis here. And here's the key thing to concentrate on in your review. This is the income statement of this company. The income statement for the month of June. There's the sales revenue. There's the cost of goods sold at the standard price. And there's our gross profit. Then we have the variances. There's the material price variance we just calculated, the materials quantity variance we just calculated, the labor price variance we just calculated, and the labor quantity variance we just calculated. Plus, if you complete the overhead variance, we had a favorable variance of $190. Add that to the gross profit at standard. In other words, we projected $65,500 of projected planned profit. Taking into account materials, labor, and overhead variances, we've made another $190. Thus, our gross profit was $65,690. Our selling administrative expenses were given as $40,000. We made a net income of $25,690. This is called an income statement variance analysis, where we take into account our planned profit, compare it to the unfavorable or favorable of our three production costs, materials, labor, and overhead, and to see how we ended up. So in this company, with the positive $4,000 favorable manufacturing overhead variance, we ended up doing pretty good. We were $190 over our plan. We made $190 more than we thought we did, and thus that contributed to the net income of the company. So in other words, we're looking at the efficiencies, the variances of determining the price of our products and the amount of material usage, the price of our labor and the labor hours usage, and the amount of our overhead that was applied and actual. If you notice in the problem, manufacturing overhead incurred was $189,500. Manufacturing overhead applied was $193,500. In other words, we $4,000 over applied our overhead. So we used more than we planned. Our actual was less than what we planned. That's the $4,000 unfavorable variance. So that's problem 11-2. We've seen how we calculated the variances, the analysis there. And we've also seen how to put it into a statement that kind of sums it all up. We planned on making $65,500 in gross. We actually made $65,690 due to the favorable variances. More specifically, overhead saved us. And what that does and how that looks at our net income. Notice there's no variance analysis in selling and administrative expenses. So this is a good problem to review or use as a template for your quiz work coming up on Wednesday and for the examination work coming up into a couple weeks. Now, what does that mean in regards to, okay, who's going to yell at us? Why are they going to yell at us? What's going on here? Well, let's take a look at the balanced scorecard approach as talked about in the chapter. The balanced scorecard is like a SWOT analysis, and I think I mentioned that before. It's like a SWOT analysis. It incorporates financial and non-financial measures in an integrated system that links performance measurement and company's goals. Evaluates the company performance from a series of perspectives. In a SWOT analysis, it's strength, weakness, opportunity, and threat. I'll say that again. It says SWOT. Strength, weakness, opportunity, and threat. That's the analysis of a particular strategy. In the balanced scorecard, it's financial, customer, internal, learning, and growth. And this prospectus gives us both financial and non-financial. Are we over budget? Do we have unfavorable, favorable? That's the financial side of it. How does our customer in relation to this? Was our customer happy with the product or not? Was the internal process correct? Did that provide the inefficiencies in the financial variances? The internal process. A lot of you, if you go on study, this is called Six Sigma. If any of you have ever heard of that. If you've never heard of it, don't worry about it. It's called Six Sigma analysis. How are our internal processes giving us the proper financial and performance data? And then the learning and growth, what do we learn from this process? Are we screwed up financially? Are we not treating our customers correctly? Are we having lousy internal processes? Or are these all doing well? Or a combination of both? Where do we go from here with this data? Are we making money according to what we thought we'd make money? Are we treating our customers fairly? Is our process of efficiencies correct? And what do we do about the future? What does this tell us about the future? This, if you're going to be a department manager, if you're going to have your own business, one of the first things a banker will ask you if you're going to go borrow money to start a company, they would say, is there a SWOT analysis in your financial plan? Oh, by the way, do you have a balanced scorecard analysis after the fact, after you're all done with your project? Huh? What? You need to have these. SWOT, strength, weaknesses, opportunity, threats. Balanced scorecard, financial, customer, internal process, learning and growth. And the book goes on and gives some very good examples of what is considered financial information: net income, credit rating, profits. Customer. Are we retaining our customers? What's the evaluations of our customer about our product? Is there brand recognition? Internal process. Are we having any waste? Is our planning accurate? Are we using our labor correctly? And in learning and growth, what are our ethics? Are we training our people properly? Do our employees are giving us feedback about how they're doing? Employee loyalty, morale. What do we do with all these things to plan into the future? It's a very important concept, balanced scorecard. A lot of companies use SWOT, but balanced scorecard gives you a little bit more details. And speaking of that, I have a video that Southwest Airlines, how they used the balanced scorecard. Let's take a look at that. I'm telling you, Professor Hasse is on the ball today. Give him one day off with the family to clean things up, and he comes back firing on all cylinders. Here we go. Let's see. There we go. All right. Let's make sure we get this up. Okay. Let's try this out. Again, the son of a gun. I know why. I got a warning this past weekend. There's copyright infringements here. Son of a gun. Well, enough of that. Sorry, guys. We got to go to plan B. All right. Let's go back to this. Because I take these videos from other sites, and when I bring them in, Zoom checks them out and says, you know, Mr. Hasse, there's copyrights here. You can't play this. All right. Thanks a lot. So let's go back to this. Mr. Hasse's always ready for plan B. So as I said, let's take a look at some definitions of the balanced scorecard. Which of the following would not be an objective used in customer perspective of a balanced scorecard? All right. The answer is earning per share, because a financial scorecard, an item. In a balanced scorecard, we're concerned about are we retaining our customers? Do they recognize our brand? Are our customers recommending our product to others? But earnings per share is a financial scorecard item. Balanced scorecard, this is what the video said for Southwest Airlines. Balanced scorecard provides financial and non-financial measures. It creates linkages between high corporate goals and the people who manage underneath those high level areas of making sure the company is running efficiently, like you and I. provides for measurable objectives for non-financial measures. And it goes, do we have a loyal employee workforce? Are our customers being taken care of? Are our processes of getting information correct? And it integrates these companies' goals into a single performance measurement system. In other words, if a company's doing all things right, the company will be making profits, they'll be retaining customers, they will be having loyal employees, and their systems of managing all these will be correct. But trust me, every company has issues with this. Every company has issues with customers. Every company has issues with profitability. Every company has issues with employee loyalty and are employees happy. Every company has issues with, are the strategies and the efficiencies of the organizational management correct? This is where the balanced scorecard can help a company figure this out. SWOT, balanced scorecard. But you need the financial data and the efficiencies of your system to provide you the information to judge all this. And that's why this is very effective. And that leads us into chapters 12, 13, and 14, which gives us the financial data and the financial systems to provide us with this balanced scorecard information. Sorry about that video, guys. Darn it. Okay. So let's move along to our next topic. Capital investment, okay? Capital investment. What is capital investment? Capital investment is buying computer equipment. Capital investment is buying buildings. Capital investment is buying a new telephone system. Capital investment is buying a new factory. Capital investment is purchasing and training new employees. Because all of these are assets of a company. All of these are investments in the future. When we hire a new employee, when we buy a new computer system, when we buy a new phone system, when we purchase a new building to work in, we're planning for investment return in the future. Are we going to, is this asset, are these employees, are these fixed assets going to provide us with a return in the future? That necessitates the investment. Chapter 12 talks about how do we measure that future? And they use what is called the cash payback. If any of you looked at the video that I posted last evening, the writer of this textbook, Mr. Whatever his name is, Paul somebody, is telling you about cash payback, net present value. These are a way of analyzing the future of an investment today. Now, how do we make these investments? Well, we do projects that are requested by the employees of the company, the management. Hey, you know what? We need a better factory. Our factory is old and run down. We need a new investment in factory. You know what? My computer is 10 years old. It's time for a new computer. Can you buy me a new computer? Or my phone system kept breaking down. We need a new phone system. All right? So these proposals go to management and are approved finally by the board of directors of the company to spend the capital to purchase these products, purchase these assets. In return, we're going to be more efficient, produce greater profits, produce cash flow. That's the future. Are the investment in these assets going to generate a return in cash? If I'm a financial person or an accounting person, I account for not only the investment in the asset, but also the cash flow generated off that investment to tell me it's worthwhile. All right. A lot of you are ending your freshman or sophomore years of study. Right now, you're probably analyzing, is the investment that you're making in your education giving you value, return? Now, monetarily, you can't measure that because you're not working. Or some of you are working, but you're not getting a cash flow out of the investment. Your investment return right now is, am I learning? Am I learning properly? Am I learning accounting? Am I learning finance? Am I learning how to write? Am I learning how to speak, communicate? Am I learning how to relate to people? That's your education. That's your return. But down the road, 2, 3, 10 years down the road, that will be a monetary return because you're getting paid to do a job that does all those things. So that's the relationship of why this is called a capital investment. The return isn't today. The return is in the future. And depending on that capital investment, the return could be next month, but the return could be in 10 years. You as the investor or the manager investing in that capital have to understand when are you going to get the return off that investment. And what is cash flow? Well, first of all, it's money going out. Your purchase of that asset, the initial investment. Repairs and maintenance and operating costs of managing that asset. And then upgrading the asset. Many times we buy computers or we buy telephone systems, we keep them for a couple years, and then all of a sudden we determine, geez, these are becoming out of date. So instead of buying new computers or telephone systems, we upgrade them. We put in microchips. We make them faster. That's overhaul of the equipment. We make it, we upgrade it. So the spending of this money in this asset will generate cash inflows, sales, profits. The disposal of the equipment or the selling of the equipment. The combination of these inflows should be greater than the outflows. If they're not, don't make the investment. If I go to Harvard and spend $70,000 a year to go to school, so after 2 years of going to Harvard, I've spent $140,000 of 2 years at Harvard. I have to ask myself the question, am I getting $140,000 of education? I bet you kind of are if you put it in relative terms. But at the same time, when am I going to get this $140,000 back in cash flow? Am I going to get hired by somebody who's going to pay me that kind of money over time? Maybe, maybe not. That's why it's called an investment. You're taking a risk on the future return of that capital. There's a huge sentence I just said. You're taking a risk of the return of the future of that capital investment. This analysis in chapter 12 kind of helps you say, yeah, I guess this is worth the risk. I think we're going to go ahead and do it. So chapter 12 is talking about how we get the money back. And one of the ways is called cash payback. It identifies how long it takes to get the money back. We're investing $130,000 in an asset. It's going to produce $24,000 a year in annual positive cash flow. It's going to take roughly about 5.5 years to get that money back. Now, many companies say, you know, that's great, but I want my cash back in 2 years, not 5. So they'll say, all right, let's invest in something else. The University of Laverne, the Citrus housing area, the dining hall. That's an investment of, can I tell you this? I'll tell you it. That's an investment of $5.5 million. We charge room and board for that facilities. How did we end up getting the money to borrow to build that building? Because we told the lending people that we were going to pay that money back in 10 years. That's our cash payback. Right now, people are jumping out of the windows at Founders Hall because there's no income being generated by the Citrus Hall. That's going to push our timeline back for payback a little bit longer than 10 years. People are freaking out. That's why Devorah Lieberman sends these little emails to you every week and videos saying, everything's fine, come on back, we need your money. But that's an investment. How long does it take you to get the money back that you're investing? Right? That's the question I just asked you earlier about your college education. You're not going to get the money back from spending and borrowing money to go to college until for many years. But is that, in your perspective, worth the risk? I tend to think so. But that's what we call by cash payback. How long it takes us to get the money back. Here's an example. Here's a company that has an investment of $300,000. They're going to generate these cash flows in positive cash flows over the next 5 years. At what point do they exceed the 300,000? Well, it's between year 3 and 4. They've had $240,000 of cash back after year 3 and $360,000 at the end of year 4. So somewhere between year 3 and 4, and that between that year, probably 3.5 years, 3.25 years, they get their money back. Companies, managers, investors, bankers, board of trustees, board of directors want to know how fast we get the money back of the capital investment. And then that's the main discussion of chapter 12. So we're going to look at Wednesday exercises 1, 2, and 3 and problem 12.1a as ways of calculating and looking at capital investment. Because when we looked in chapter 11 about the variance analysis of standards versus costs, what produced those standards and actual costs? An investment in an asset, a capital investment. That produced the revenue. That produced and necessitated the expenses, the cost. Without the capital investment, we cannot generate any variances. We cannot do a balanced scorecard. We cannot do a SWOT analysis. The capital investment is the key, and that's what you'll be studying a lot of in your future classes like business finance in down the road. So we'll be looking at examples of that in exercises 1, 2, and 3 and problem 12-A on Wednesday. Also, hopefully, we'll look at a better video, and Mr. Hassey's got to find out a video that I can use without a copyright, which will be very important. And so let's just bring this up one last time. And that's what we have to look forward to in the coming week. So a quiz will be posted on Wednesday for you to do on Sunday. Then that'll be our last graded work until the examination on May 20th to May 23rd. So that's where we stand right now. Take a look and monitor that problem 11.2a. That's your template for variance analysis and income statement analysis for going forward. Also, make sure you understand the definitions of the balanced scorecard. What does it mean to have a balanced scorecard, and why do we use it? That's very important. Do we have any questions from our distinguished group this morning? Nothing. All right. Typical. That's fine. You guys are looking better than I am. I'll tell you that right now. Whew, I'm ugly, but you guys are looking good. Okay. So I'll see you all on Wednesday. Take a look at those exercises and problem about capital investment. Study 11.2. That's a good problem. The solutions are in Blackboard, and this video will be posted as a recording of our lecture today. So thanks, everybody. Have a good week. Be safe. Did I say wake? Have a good week. You guys be safe, and we'll see you all on Wednesday. Adios. See you later.
Thank you.
See you later, Mr. Hassey.
Bye, Professor.
See you, Nina.
Hi, Mr. Hassey. So the quiz is due on Sunday?
Sunday, yes.
Okay. See you, Mr. Hassey.